Okay, good morning. It is May 4th, and so I think this is our first video of May. And so, of course, we need to start off with a Snapple fact. And the Snapple fact of the day is the first person crossed Niagara Falls by tightrope in 1859. That's kind of interesting. So today I want to talk about two things. It's a great show for you today. I want to talk about two things. One is going to be nonlinear modeling. We did linear modeling with lines of best fit, which is great, but not everything is linear. So sometimes things look a little curvy, and this is a perfect example of something, some data that looks a little curvy. So here we have, if you just look at the bar graph here, we can see that we are definitely looking like this is kind of an exponential thing. For those of you who did the exponential graphs, you can see that this is an exponential shape. Okay. So here's the deal. We have the number of Americans traveling abroad for medical care. And this is in thousands. So we have, in this case, it's actually even a little small for me to see. Make it a little bigger. There we go. 38,000, 75,000, 150,000, and 300,000 people going abroad for medical care. So, again, we can see that this is going to be an exponential growth sort of thing. And so I want to make sure that we can do this in sheets. And I made a small video a little while ago, okay, actually last night, about how to do this in sheets. I've already shown you how to do this in for a linear function. Now I'm having you watch a little short video on how to do this with an exponential or anything that's nonlinear. It'll be the same whether it's exponential or quadratic or polynomial or whatever. Okay, so so here's what I did. I put in the data. We're going to have to zoom back out. So I put in the data into sheets, and I went through all the steps here. And we can see here that the correlation coefficient is 1, which means that the data fits, an exponential model fits the data perfectly. It can't fit better. 1 is the best fit possible, or -1 if it has a negative slope. So, so the model here is going to be y equals 2.38 e. E is a special number, 2.718. It's a constant. To the 0.691x. And again, the r squared equals 1 is over here somewhere. It shouldn't be that close. It's not part of the equation. So this is what the exponential model is for people going abroad for medical care. And so the x value here is the number of years since 2000. So this is 2004, 2005, 2006, 2007. So here it is. This is an excellent example of exponential growth. And again, I have a little video to show you how that went. All right, so our second example here, again, I'm going to zoom back in. Our second example involves number of Americans, try again, is movie attendance. So we can see here that movie attendance looks like it started a little bit on the lower side, went up to a peak, and came back down to, again, a lower value. So this looks like it might be a quadratic thing. Again, certainly not linear. If it was linear, it would go up like this and keep going. And so, again, I put in this nice data into sheets and had sheets figure out for us what the quadratic function would be that represents this data. So I want to show you what that looks like. So I'm going to have to zoom out a little bit. So here's what that looks like. And again, this is the number of years since 2000. And so here we can see that 0 years since 2000 is actually 2000. So we have 1.45. I'm assuming this is in millions. Billions. This is the amount of sales, by the way. So this is $1.45 billion in movie sales, 1.5 billion, and so on. So we can see here that if we tried to fit a quadratic model to this point would have been much nicer if it was over here, but we fit a quadratic model to this, and I want to call your attention to this number right here. So r squared equals 0.679. So this is really cool about stats. So R squared actually tells us what percentage of the change in Y can be attributed to the change in X. So X is the number of years since 2000. And so what we can say here is that 67.9% of the variation in movie attendance, revenue, is based on years since 2000. That means that, so we'll call it 68, that means 32% of the difference in, or the change in movie revenue is based on something else. Maybe it's the quality of the movies, maybe it's famous actors, the ones that people really wanted to watch aren't, in movies anymore. Maybe people are, watching movies at home, Netflix or, something else like that. So, something else is accounting for the amount of sales other than years. So again, it's a great number. It's a great calculation here. This is what percent is based on this number right here, the number of years. So that's a really cool thing to know. So if we took the square root of this, it would be a little bit higher. So our correlation coefficient would be something like 0.85, which is pretty good. It's not amazing, but it's pretty good. It's certainly not 1. And so here it is. And so here is our formula, or our model, for how much revenue there is based on the number of years. So they kind of put this in reverse order. I like to have the highest power first. So we could read negative 0.0105 x squared plus 0.0737x plus 1.46. So that should tell us how much revenue is taken in for movies based on a certain year. So back to the question here. So again, zoom in. So it says here that we want to, still on the bottom. So explain why the quadratic function was used to model the data. Y is the value of a negative. Okay, good. So obviously, as we've already talked about, the quadratic model seems to make sense because of the shape. And a in our model that we came up with, way down here, a, remember, is the coefficient of x squared. It's negative because we are opening downward. It's an N-shaped sort of thing. And what other questions do we have here? It says use a graphing calculator or sheets to create a model, which we did. And then according to the function from the model that we created, how many billions of movie tickets were sold? Oh, this is tickets, not revenue. Tickets were sold in 2007. So what we do is we just take our model and plug in 7, because that's the number for 2007, and calculate. So I did that calculation right here. And so our function value, or our model, with 7 years past 2000, in other words 2007, we put 7 into here, and do all the stuff here, and it comes out to be 1.4614. Now, according to the data, in year 7, it was actually 1.47 billion tickets. So 1.4614 was actually a very good estimate. So our model did a good job of estimating what would be the number of ticket sales in the year 2007. So I just wanted to expose you to the idea that not all models are linear models. We don't always use a line of best fit. Sometimes we use an exponential model or a quadratic model or something else that's not linear. Okay, so there ends the new information for Chapter 7. So we'll be having a Chapter 7 test on Wednesday, I think. We need to move along here quickly because the end of the year is rapidly approaching and we have 2 more major sections to do before we're done with all of our stuff. So we need to keep moving. So our next section here is going to be on money and finances. And so we'll be talking about things like investments and so on. But right now, I want to talk about taxes. And so I just stole this piece right out of your book here because it's pretty useful. It's a good way to structure all this information here. So there are 3 steps in figuring out your income tax. First, you need to figure out your adjusted gross income. Well, your gross income is just the money that you took in, without any taxes or anything else taken out. Just, you make $20 an hour, you work for, 30 hours in a week. That means your gross income is $600. So, but you know that there's income tax taken out and there's Social Security taken out and all the rest of that sort of stuff. So that's a little bit different. All right. So then, so your adjusted gross income is going to be your gross income minus adjustments. So adjustments are things like investments that you make for retirement, and or other sorts of things that go in here that are way beyond the scope of this course. But the basic concept here is that for example, a retirement account, the taxes will be paid later. So when you put money into a retirement account where you intend to pay the taxes later, you don't pay the taxes now. So what that does is it actually pushes down your gross income, which means that you'll end up in some senses paying less taxes now. You'll just end up paying the taxes later. Either way, you got to pay the taxes. So you'll start paying the taxes when you start collecting your income from your retirement account. So let's say you retire at 70. You'll start collecting your money from your retirement account, and when you start collecting that money, it'll be looking like income, and then you'll be taxed on it. So your adjusted gross income is going to be your gross income, which straight money you make, minus your adjustments, which is anything that is a pre-tax sort of thing, a pre-tax sort of deduction. And then we move on to determining your taxable income. So it's your adjusted gross income, so it's from that previous step, then minus exemptions and deductions. So the exemptions are money that the government allows you to keep to pay for things for yourself or people who depend on you, like your children, or maybe you're taking care of an elderly parent or something like that. So they say, yeah, you can keep some of that money so that you can do some stuff for yourself. And then there's deductions. So there's 2 types of things we can do. We can take either a standard deduction, which we'll take a look at in just a minute on a table, or there are other types of deductions, which again reduce your taxable income. And these are generally things that are thought to be helpful to the economy or society in general. So, for example, many people believe that being married and having a family is something that is good for society. Great. Giving charity is something that's good for society. Awesome. So that you get a chance to reduce some of your taxable income like that. Owning a house is good for the economy and society, because if you own a house, then you're going to go to Home Depot and you're going to buy stuff like a lawnmower or things like that. So that helps that business. So again, these are things here that are put into place to kind of help out the economy and society. So these are deductions and these are exemptions. Again, exemptions are money that you get a chance to keep to take care of you and anyone who's dependent upon you. Deductions are things that you can reduce your income by to provide something that's good for society or the economy. Okay. And then lastly is determining your income tax, which is simply taking your tax computation, which is actually going to be kind of complicated, minus your tax credits. So sometimes you've done something or that allows you to take a tax credit, like maybe you put in some special windows that were super energy efficient, you get a chance to have a tax credit. Or maybe you paid too much taxes last year, you get a chance to have a tax credit. Okay, so, right, okay. So we're going to use this information shortly to do one problem, because otherwise we're going to be having an hour-long video, and that's not going to be any good. So the next thing I'm going to look at is this this taxable income sort of thing. And so the taxable income, am I zoomed out? Yeah. The taxable income is, or the tax that you end up paying is based on your taxable income and this clever little table right here. So I want to say that this table is based on numbers for 2008. The tax code or the tax laws and tax code have changed since 2008. I actually happen to have a copy of what it looks like now. Here's what it looks like now. So these are for, for the year 2020. So when your taxes are due in 2020, usually they're due April 15th, but because of COVID, they're due July 15th this year. So, and it's based on what you did in 2019. So all this information here that I'm going to explain on a different table is what we're going to be using. You may ask, well, why aren't we using this table instead of this old table from 2008? Well, because all the questions in the book are based on this table right here, and I don't want to do all the extra work to do all the calculations for the new tax table. So the concepts are all the same, just the numbers are a little bit different, but you still will do it all the same way. Okay, so let's take a look at what's going on here. So we have here several different statuses here. So you can either be unmarried, divorced, or legally separated, which means that you don't have anyone else who's contributing to your income. So basically, you're a single person. So you are married, and and each partner files a separate tax return. And so in some cases, based on what the two parties make in the marriage, it may be more useful to file separately as opposed to file as one big income pool. This one here is where the two people file together in one income pool. And this one here is a situation where someone is not married, but they do have dependents. And again, whether those are children or maybe elderly parents or whatever that they're taking care of. So down here, we have the standard deduction. And so I talked before, when I was up here, about all these deductions here, like giving to charity and mortgage and your home mortgage and your income, your property tax, etc. All these things go here. If you have lots of these, then you'll use that big number to help to reduce your taxes. If you don't have a lot of those, then the government again says, here's what we're going to allow you to keep for your deductions. And your exemptions, in other words, people that are dependent upon you and yourself, you get a chance to have keep $3,500, or the government allows $3,500 for each of those, so each child or each dependent person. Okay, so here's this table. We're going to come back to this table in a minute when we do this example. But before we actually move on to the example, I do want to talk about these numbers over here, these percentages. I think this is where things are going to get a little bit tricky, and I just want to preamble it now, and then we'll go through it again in just a minute when we get to it. So, let's say we make $10,025. So here's the way this table works. This table says here that you'll pay 10% tax on anything you make up to $8,025. So in our case, the example I just made up for you just now is that we're going to make $10,025, which means that's $2,000 more than this. So you're going to pay 10% of this amount right here. And then how much money did we make over this? Well, 10,025 minus 8,025 is 2,000. So then you're going to pay 15% of whatever you made over this, aka $2,000. So you're going to pay 10% of this and 15% of $2,000. So let's say that we made $32,560. $32,560. So we're going to pay 10% of this, and we're going to pay 15% of anything between here and here. Well, since we made $32,560, we're going to pay 15% of whatever this difference is, so $32,550 minus that. We'll pay that much money, 15% of that. And then since we made $32,560, that means we made $10 more than this. That means we're going to pay 25% of $10 in here. So that's the amount that we made over this. So we are gradually paying higher percentages on smaller and smaller amounts of money. So the example that we're going to do in a few minutes will be helpful as we go through this. But I just wanted to do this first, and then we'll look at it again in just a minute. Okay, so we're going to need this table and this thing right here to do this example. So I'll just keep them right in the background. Okay, so here's the deal. So let's say we have somebody who's a single person. They have no children, and their gross income is $62,000. The adjustments are that they pay $4,000 into an IRA, which is an individual retirement account, which is an account that you can invest in pre-tax. In other words, you don't get taxed on this $4,000. So we'll talk about that in just a second, how that works. And then these are the deductions for this person here. They paid $7,500 in their mortgage interest. They paid $2,200 in their property tax. They paid $2,400 into charity, and they paid $1,500 for medical expenses that were not covered by insurance. If the medical expenses are covered by insurance, well, then you didn't really lose that money. So you didn't reduce your income by that much money because insurance paid it. But in this case, insurance didn't pay the $1,500, so we need to take a look at that. Okay. Oh, and there's a tax credit of $500. Let's say that whoever this person is, they just paid $500 too much last year because, I don't know, they made a mistake. So they're going to get those $500 back this year. Okay. So step one, according to our thing right here, is to determine the adjusted gross income, which I have right here. Determine your adjusted gross income, which is simple. It's your gross income minus any adjustments. So there's the adjustment, $4,000. There's your gross income, $62,000. So $62,000 minus $4,000 is $58,000. So $62,000 minus $4,000 equals $58,000. And that is our adjusted gross income. Okay, now we need to find out our taxable income. So we take the gross income, which we figured out here, and we subtract away all the exemptions and the deductions. So the exemptions are that this person here is a single person and they have no children, so they get a single exemption just themselves. So back to our little table right here. The exemptions, in this case, $3,500. So we're going to do gross income, which is $5,800. I'm sorry, $58,000. $58,000 minus $3,500, which we just got from the table, plus the deductions. Well, here are the deductions right here. $7,500, $2,200, $2,400, and $1,500. Now this $1,500 here is a little bit tricky because medical expenses actually have to be pretty big in order for you to be able to claim that as an actual deduction. So as it turns out, it has to be 7.5% or more of your gross income. So in this case, the gross income is $62,000. 123 times 0.075 equals, that is $4,650. $4,650, if I can see that. There we go. $4,650. $1,500 is not as big as that or bigger. So we actually can't take this as a deduction because it's not big enough. So the laws get kind of tricky and complicated. So we're going to add up the rest of these numbers right here. So $7,500 and $2,200 is $97. 11,700, 12,100. So plus $12,100. I think, did I get that right? I hope. 7, 9, 11. Yeah, it seems about right. So 12,100, 15,600. So 58,000. 58,000. 1, 2, 3. Minus 15,600. 15600 equals 42,400. All right, so our taxable income is $42,400. That's the taxable income. Now, here's where the tricky part comes in. Doing the actual tax calculation. All right, so your income tax is going to be whatever the tax calculation is minus the tax credit. Well, we already know that's $500. So the tax calculation is the tricky part. So again, we're going to be working with $42,400. $42,400. Okay, so we got to go to our table here, and we need to make sure we're using the right part of the table. So this person is a single person. And so we're just going to go right down here using all these numbers here to help us to figure out how much tax we're going to pay on $42,400. Okay, so we know that $42,400 is bigger than 8025. It's bigger than 32,550, but it's smaller than 78,850. So what we're going to do is, well, I'll just write out what we're going to do. So we're going to pay 10% of $8,025. Then we're going to pay 15% of whatever this is, 32,550 minus 8026, which I'm going to do right here. So 3550, 32,550, that's what I meant to say. 32,550 minus 8026, 802, actually I'm going to do 8025. That turns out to be 24,525. 24,525. And then we're going to pay 25% on whatever we have made above 32,550. So we have 42,400, and how much of that is above that? So we're going to do 42,400 minus, what have I just said here? 32,550. 32,550. So we're just going to calculate each of these things right here. So 10% of 8025 is 80250. I'm just going to write that down here. 80250. 80250. Then we're going to do 15% of that. So 0.15 times 24,525. 24,525 equals, that's 3678.75. 3678.75. And then we have 25% of that. So 32,550 minus 42,400 equals, something went bad here. Oh, I did it backwards. 42,400 minus 32,550. It's the same thing anyway. It's 98.50. So we're going to do 25% of that. So times 0.25 equals 24,6250. 24,6250. So we're going to add up all of that stuff right there. So 80250 plus 3678.75 plus 2462.50 equals 6943. 6943.75. So this is our this is the tax we're going to pay, or we should have already paid, right? Because it already got taken out of the taken out of your paycheck. But we got a tax credit of $500. So $6,443.75. So that should be the amount of tax that we pay, $6,443.75. So throughout the year, the money's being taken out of your paycheck, and let's say that they took out $7,000 throughout the course of the year. Well, cool. That means that they took out too much money. You're going to get some back when you file your income tax. Let's say they took out only $6,000. Well, not so cool, because they didn't take out enough, and so therefore you're going to have to pay $443.75. So that's the way that works. And we are at almost 30 minutes here, and that's long enough. So sorry this was a long video, but you know, got to do what we got to do here. So yeah, test on Wednesday, but not on this. So I'll have more to say about that later. So be safe.